You just won $1 million. Every number matched. You check the ticket once, then twice, then a third time, just to be sure. Your hands are shaking. For a moment, every financial problem you've ever worried about disappears. Not under control. Gone. Completely. You start imagining a life where money is never a problem again. No more checking your bank balance before making a purchase. No more lying awake wondering how you'll pay the next bill. Just freedom. Now, fast forward 3 years. You're back at your old job. The house is gone. The relatives who used to call every day during that first year have stopped reaching out, mostly because there's nothing left to ask for. And the hardest part? You're not just broke. You're confused. Because you didn't do anything that seemed reckless. You paid off your debts, you bought a home, you helped the people you cared about. You didn't blow it all in a casino or spend it on something outrageous. You simply made what felt like reasonable decisions, one after another, until one day, the money was gone. So what happened?
This isn't just one person's story. It's a pattern researchers have been documenting for decades, across thousands of lottery winners in different countries. And it points to an uncomfortable truth. Money doesn't solve money problems. It reveals them. Here's what almost everyone believes, even people who should know better. If you just had enough money, financial stress would disappear. More money in the bank should mean more security. It sounds obvious, but it isn't true. In fact, it's wrong in a very specific and measurable way. Behavioral economists have a name for the belief that one day you'll reach a certain amount of money and finally stop worrying about it. It's called the arrival fallacy. The idea is simple. You imagine financial peace as a destination. Once you cross a certain line, you believe you'll stay there forever. But that's not how it works. The moment you reach that line, it moves. What once felt like more than enough quickly becomes your new normal. You don't actually arrive. You just find yourself standing at a new starting point, chasing another finish line. Lottery winners give us one of the clearest ways to see this in action. Almost no one else experiences an instant financial reset. There's no gradual increase in income, no years spent learning how to manage larger amounts of money. One day, they're ordinary people, and the next, they're millionaires. If money alone could solve money problems, this is exactly where we'd expect to see it. A sudden, life-changing amount of cash, with everything else staying the same. In many ways, it's the closest thing personal finance has to a controlled experiment.
Researchers Jonathan Guryan and Melissa Kearney followed lottery winners for years by matching state lottery records with personal bankruptcy filings. What they found was surprising. Winning a large jackpot didn't eliminate the risk of bankruptcy. For many winners, it simply postponed it. Compared with people who had similar financial situations before the win, the outcome often looked remarkably similar a few years later. The money bought them time. It didn't necessarily buy them a different future. Financial planners who specialize in helping people with sudden wealth have noticed a similar pattern. Year one usually brings a surge of spending, generous gifts, and loans to family and friends. Years 2 and 3 feel stable as the new lifestyle settles in. Then comes the difficult part. Savings begin shrinking much faster than expected, and the money starts disappearing at a pace few people saw coming. One financial planner who worked with multiple 7-figure lottery winners said he watched the same story unfold again and again, regardless of the client's age, education, or income before winning. And that's the important point. The lesson isn't that lottery winners are simply bad with money. That's the easy explanation, because it lets the rest of us believe we'd be different. The real lesson is much less comfortable.
A windfall doesn't automatically change your financial habits. It simply gives those habits more money to work with. If your habits were pushing you toward overspending on a $50,000 income, they'll often push you in the same direction with $2 million. The only difference is that now the consequences take longer to show up, and there are fewer people willing to tell you no.
Behavioral finance doesn't just describe this pattern, it explains why it happens. It is often referred to as hedonic adaptation by psychologists. Your brain doesn't judge your life by absolute numbers.
It judges your current situation against whatever you've recently become used to. Imagine winning $1 million. Your brain doesn't label that as permanently secure and stop thinking about money forever. Instead, over time, it quietly resets your expectations. The $100,000 house that once felt like a dream now feels ordinary. The upgraded lifestyle that once seemed luxurious becomes your everyday life. And once something becomes normal, it stops feeling like abundance. It just feels normal, which means you start wanting more. The same thing happens on a smaller scale. A $10,000 raise feels incredible at first. For a few weeks, maybe a couple of months, life seems different. Then you adapt. Before long, that higher salary simply feels like your salary. The excitement fades, but your expectations stay. Now imagine that same psychological process, not with a raise, but with millions of dollars. A few years later, someone can still have more money than most people will ever earn in a lifetime, yet feel financially uneasy. Not because the money wasn't enough, but because their expectations rose right alongside it. The problem was never just the number. It was the gap between what they had and what their mind had already started expecting.
There's another force at work here, and it has less to do with psychology than with people. When someone suddenly comes into a lot of money, they don't just become wealthier. They become easier to find. Financial planners who work with lottery winners and other sudden wealth clients often describe the same pattern. Within the first year, the requests start pouring in. A family member needs a loan. An old friend now has a business idea they are confident about. Someone you haven't heard from in years suddenly has an emergency. Individually, each request sounds reasonable. Together, they can quietly consume a huge portion of the money before the excitement of winning has even settled. The difficult part is that saying no feels cruel. These are people you care about, people who may have helped you in the past. Now that you finally have the means to help, saying yes feels like the right thing to do. And often, it comes from a genuinely good place. The problem is that generosity isn't the same thing as having a plan.
A lottery jackpot, even one worth millions, is still a finite amount of money. Without clear boundaries, that money slowly turns into solutions for everyone else's problems. One reasonable request becomes another, and then another. Until one day, you look at your account and realize the money solved almost everyone else's financial problems, except your own.
This is the part most people never think about. A financial windfall can change your bank balance overnight. It can't change your habits overnight. It doesn't automatically make you better at budgeting. It doesn't make it easier to say no. It doesn't change your tolerance for risk or teach you patience. Those behaviors were built over years, and no amount of money can rewrite them overnight. If someone relied on shopping for comfort before they became wealthy, that habit doesn't disappear after a windfall. If they avoided budgeting before, they're likely to avoid it afterward. If delaying gratification was difficult before, having more money often makes that weakness easier to indulge, not harder. In other words, the habits that once made money feel tight don't disappear. They simply get a much bigger budget. That's why researchers have found something surprisingly consistent. People who receive financial education, or who intentionally change their financial habits before receiving a large windfall, tend to keep far more of it than people who receive the same amount of money without changing their behavior first. The biggest difference wasn't the amount of money they received, it was the habits they brought with them.
If having more money isn't enough, what is? The research keeps pointing to the same three factors. First, people who already have systems in place tend to do much better. They have automatic saving, clear rules for lending or giving money away, and a lifestyle they refuse to let expand without limits. Second, they treat a windfall as something to protect, not something to spend. Instead of seeing it as extra income, they see it as capital that needs to last. That small mental shift changes countless decisions. And third, they work on their financial behavior itself, not just their income. Because if your habits don't change, a larger bank balance simply gives those habits more room to operate. The encouraging part is that none of this requires winning the lottery. You can build those systems today. You can set boundaries today. You can improve your financial habits today. No jackpot required. Think back to that moment. The winning ticket, the shaking hands, the overwhelming feeling that every financial problem in your life has finally disappeared. The truth is, the number was never the real issue. Your brain adapts to whatever you have. The more money you have, the more people expect from you. And the financial habits you have today are the same ones you'll carry into any amount of money you ever earn, whether that's a lottery jackpot, a promotion, or simply a bigger paycheck next year. You don't have to win millions to see this process in action. You're already living it every month, with every paycheck. The only question is, have you noticed?